sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Hello again from the 6th floor of 3 Financial Center in West Little Rock, Arkansas. This is the Get Ready for the Future show from GenWealth Financial Advisors. My name is Scott Inman, along with me, GenWealth co-founder John Shrewsbury, as we get set to answer your questions again on the show, helping you discover, protect, and share true financial independence. So, wonder what's on your mind today. Are you worried about taxes in retirement? You worried about a recession? Are you wondering if you can retire comfortably with $1 million? Well, then you'll want to hear the questions today, because we're addressing all those things, John, and they are very common questions to everyone I know listening, but also even in our client meeting rooms these days.
Absolutely. People have all kinds of questions and concerns, and that's why we do this show in the way that we do, because we want to come straight at you with answers to the most frequently asked questions, not only in our meeting room, but from all of the channels that we have to communicate with you. We appreciate the opportunity to engage with you. And of course, if you have a question, you can text us at 501-381-5228. It's 501-381-5228. And we will be more than happy to try to tackle that question for you.
Yep. You can also send us an email to show@getreadyforthefuture.com. So time to dive in with Ashley via text message. The first question on the show today is, I'm very blessed and have worked very hard to save. I'm still worried it may not be enough. Can you retire comfortably at 60 with $1 million? Ashley, the answer is it depends. You hear that from us a lot, right? It is definitely possible, but there are so many other variables that we need to dig into. Now, first of all, $1 million isn't what it used to be, John. That was the gold standard, right? 20, 30 years ago, if you had $1 million, you were bulletproof.
Oh, yeah.
Not so much anymore.
But, and I think that it really does depend on your lifestyle.
Yep.
You have to think about also how healthy or how low is your Social Security payment during that time. You've worked very hard through your life. Hopefully you've had good income, and that has equated to a good Social Security benefit coming down the road at 62, 67, 70, whenever it's best for you to take Social Security. But Scott, I have sat down with clients most recently, and they've had $1 million, and they were doing just great. Not a problem at all. Matter of fact, they were below $1 million. And I just had a review yesterday with someone who had below $1 million, but they're doing just fine. I had another review not too long ago with a client that has over $1 million, and they were requesting additional money. And I was going, okay, let's be sure we understand the effect on the long-term nature of your retirement plan and what the ability is of your retirement plan to weather a storm at this high of a withdrawal rate. And so it does really depend on your circumstances. It depends on a number of things, but I think the focus has got to be not on the asset level, but on the income level.
Yeah, and when we talk about that, we mentioned that these are very common questions in our client meeting room. When we bring people on to the GenWealth Ready to Retire process, it is phrased this way, not exactly like Ashley did, but it usually gets phrased to us, how am I doing? They'll lay everything out there, all of their retirement savings, and tell us about their retirement goals. How am I doing? Before any planning takes place, that's not really a question we can answer. It becomes apparent through the planning process, the answer to that question, how am I doing? And as John has already alluded to, it's not about the assets, it is about the income. So there's nothing magical, Ashley, about $1 million. So what we want to work with you, because you've given us a couple of variables here, can I retire comfortably at age 60? Okay, so that is a fairly early retirement. You're going to be 2 years prior to being eligible to receive a Social Security benefit. So you are going to have to live, assuming no other income sources are in play here, without completely off of your assets for at least 2 years. But what we don't know is, are you going to retire with a pension? Is there another guaranteed income source in here that we didn't get in your question? Are there resources from a spouse? We don't know, Ashley, if you're married or not. We're going to assume the way you phrase the question, maybe you're not, but if there is income coming from a spouse who might continue to work or has a pension, that is a consideration. I want to show you a graphic for our video audience that kind of shows the way we would begin to build this retirement income plan for Ashley and for anybody else who is wondering, are my assets enough to retire when I want? Well, you're looking on the screen, if you're on the video version of our program, a house. Now, what's a house got to do with a retirement income plan? Well, a lot, actually. If you look at everything below grade, right, all of that in the dirt, that's the foundation. And that is the least impressive to look at in a house, but it is the most important part of the house, John.
It absolutely is. And that's what I would advise Ashley to begin to do, is to take a look at this graphic and go, okay, what is the equivalent of my foundation? Well, the equivalent of your foundation, Ashley, has got to be your required income. Now, let me introduce to that a definition. Required income is the money that you need every month to pay your obligations, to pay your bills, to take care of the basic necessities of life. What is that? Food, clothing, transportation, shelter, taxes, insurance. Those are kind of the big five, if you will. And I think that those things are, and maybe a few other things, can be qualified as required expenses. What you want to do is to match required expenses with guaranteed income. What is guaranteed income? Well, for the most part, Social Security is a guaranteed income source. It is an obligation of the federal government to pay you a check, and the chances are very, very, very high, despite what you hear in the media, that Social Security check will be there for the rest of your life. The chances of a politician voting to cut Social Security are slim and none, and Slim just left the building. It's just not going to happen. There is no political survivability of someone doing that. As long as the government has a printing press, you're likely to get a Social Security check. So let's put that to bed. So does your Social Security check equal your required income need, your basic living expenses? If the answer to that is no, then you've got to ask yourself, okay, do I have a pension? A pension is a rare bird these days. You don't see them very often, but pensions are out there, and some people do have them, and some of them actually increase in value over time as far as their payment is concerned. But if you don't have a pension, then you've got to figure out how you can create your own version of a pension, and that would be guaranteed income from some type of annuity product. Now, annuities have positives and negatives all across the board, and there are situations that make sense to use an annuity in retirement, and this is one of them when that required income amount is higher than what your Social Security check is. So you want to plug in maybe another guaranteed stream of income, and that's what an annuity would do, is it would guarantee a stream of income to you that would accompany with your Social Security to cover your basic living expenses. Now, that is the foundation. Scott, let's go from there and build up on the house, because nobody lives on their foundation.
No, they live in the rooms of the house. And as we go back to that graphic, that is really, in retirement income terminology, going to be what we call your desired income. So let's assume that Ashley does have enough guaranteed income for that foundation to cover her basic lifestyle. Then that means that $1 million is going to need to provide her discretionary monthly income for the rest of her life. So how do we provide that? We ascribe to the bucketing strategy. So in other words, the investment strategy that is played out here for Ashley for a ready-to-retire client is we want to have very conservatively invested dollars for the money that Ashley would be taking at age 60. And probably for the next 5 years, we don't want the market to crater that account value. We want to be able to count on that desired income being very predictable that comes to Ashley on a monthly basis. Now, as we step out in time, we have software that tells us to the dollar how much needs to go into each one of those segments. And for the money that's not going to be used for 5 years, we take a little more risk so we can get a little more reward. 10 years, 15 years, Now you're talking about growth strategy. And the reason that we need to be in a growth strategy, which equates to being in the equity market, is because whatever that discretionary income starts out for Ashley at age 60, by the time, John, she's age 70, it's going to need to be almost twice that.
Absolutely. Scott, you were very eloquent in describing that bucketing or segmented strategy. I think about it this way. Now, later, and much later. And so your now money needs to be very, very safe because you need it now. You need it in the next year, 2 years, 3 years, 5 years. The later money can be a little bit more aggressively invested, maybe not as much as the aggressiveness of the much later money, but it's sort of a midterm bucket, more of a balanced approach, if you will. And the later bucket needs to be in equities because equities and real estate are the only two asset classes historically that have allowed people to keep pace with inflation. So that bucketing strategy sort of sits on top of that foundation, that income structure of guaranteed income to meet your required expenses. On top of that is the bucketing strategy that provides for not only your discretionary income needs, but that all-important inflation adjustment. Scott, we've seen with all the inflation things that have gone on the last couple of years, we've seen a lot of our retired clients coming back to us going, hey, about that inflation thing, is it time? Is it time for me to get that increase that we've been programming in? And so that's why we bucket like this and why we invest in equities, to give you that opportunity. The good news is the equity markets have been excellent, and we've been able to harvest gains out of those equities, put them in the fixed income bucket, and then increase income accordingly.
Yeah, and then the top of the house, the attic space, it's where people store their things that they think someone's going to want, right?
Yep.
Well, that is your legacy/longevity bucket. Now, it's a dual purpose here because, Ashley, we don't know how long you're going to live. Now, we can make some assumptions based on your health, based on statistics, but the reality is this income plan has to be perpetual. So if it comes to an end on the first run, you've got to have more money in the attic so that you can continue to have income to live on. But if you don't live to that assumed age, it would be passed on as your legacy to your heirs.
I have to share a client's comment the other day. She's been a client for 10 years. Every year she comes in and she says, I just don't want to eat cat food. That's all there is to it. When I'm old, I don't want to eat cat food. Yeah. And so we're planning to make sure that she does not eat cat food in retirement.
I hope, Ashley, that answers why we answered your question. It depends, because the planning process dictates whether you can retire comfortably at age 60 with $1 million, or whatever age and whatever asset level. So I would encourage you, if you're listening today and you have a question like Ashley, if you're closing in on retirement, trying to figure out if you can retire and how much income will your assets provide, walk through the GenWealth Ready to Retire process with us. You can begin that process by sending us an email to show@getreadyforthefuture.com, or you can call us toll free. That's the easiest way, 866-653-PLAN. That's 866-653-7526. Our next question is from Charlotte in Texas. I'm 55 and planning to retire early. I've got $550,000 in my 401k, $300,000 in an IRA, and the rest is in non-qualified accounts. What do I need to be aware of to try to decrease the amount of taxes I have to pay? Great question. Again, another one that's top of mind for many clients when they come in and go through the planning process, John. So, first of all, great for Charlotte to know what a non-qualified account is, and for the rest of us, let's give you a quick explainer on that. What she's referring to is basically it's a taxable account, non-retirement account, if you will. The qualified part of that would be a qualification to the way it is taxed. So your 401k, qualified account. IRA, qualified account. Your non-qualified account means if there's a trade that happens, it usually creates taxation. So knowing how your different accounts are taxed is a big piece to this. Now, as far as the question part of this, John, on Charlotte's piece, how do I need to be aware of and try to decrease the amount of taxes I have to pay? I think the first thing, when she says she's going to retire at 55, we need a plan for income until age 59 and a half, because certainly in the IRA side, you need to wait till 59 and a half. There are some things that she could do to potentially not be penalized from her 401k.
Yeah, there is a provision in the law that allows you to take withdrawals from your 401k plan between age 55 and 59 and a half, and it not be subject to that traditional 10% early withdrawal penalty. Now, your 401k plan, by all intents and purposes, is an accumulation vehicle and not necessarily an income producing vehicle. So you have to be a little bit cautious about what you do with that. And you would want to allocate money into something like a money market account or a short-term bond fund or something along those lines to deal with those distributions between age 55 and 59 and a half. Because the one thing you don't want to have happen is for the market to go down. You're invested in the market in the 401k plan, meaning the equities market, and then you don't have enough money to sustain those withdrawals over that period of time for the amount of money that you've set aside there. But you can access that money. And in this case, Charlotte also doesn't tell us how much money she has in that non-qualified account, but that certainly is a way that you could bridge to the qualified money and not have to worry about all the complexities of 55, 59 and a half, or what have you. You could use that non-qualified money rather between age 55 and 59 and a half, and then tap into your qualified money at 59 and a half. However, Scott, I would tell you that if I had the numbers in front of me, what I would want to do is to run some scenarios and really strategize this, because that non-qualified money, mixing it with the qualified money, can have a really positive effect over into your retirement. So I think I would really want to really understand all the dynamics of her retirement program before we actually made a final recommendation to her.
Yeah, so you think about that 401k and IRA, as long as, assuming that the 401k is all pre-tax here, she doesn't say otherwise, every dollar that comes out of that in retirement is going to be taxed at ordinary income tax rate. So if you are at a higher bracket, because we don't know, we'd have to incorporate your other income sources here too, like Social Security, is there a pension? You want to identify your federal income tax bracket, because that actually, John, might be higher than a capital gains rate.
That's right.
In the non-taxable account.
And Scott, let me editorialize here for just a second, because I think it is important that we just continue to drive this home, because taxes is a big, big fear of a lot of people. And they hear people make these outlandish statements like 50% of your 401k plan is going to go to the government. Well, that's an outright lie. That is not happening for most people. Most people don't really understand what their effective tax rate is. Now, there's a difference in what your tax bracket is and what your effective tax rate is. When you factor in your standard deduction and the brackets that you run through your income with, most people are not paying 22%, although they may be in the 22% tax bracket. Their effective tax rate is maybe 10, 12, somewhere in that neighborhood. It's not 22%. So I think that there is some, quite frankly, unfounded fear as of this date, before they change any tax laws or anything. Right now, there is some unfounded fear about how bad taxes are going to be. And so oftentimes when I have a client that comes in that doesn't have a huge income and they're worried about taxes, I take them on this journey through the details of the tax code and help them to understand, actually, you're only paying about 10% of your total income in taxes. And they go, oh, well, that's not so bad.
Yep.
And so it gives them a different perspective. And so I think perspective is something that's necessary here. Not to say that Charlotte has the wrong perspective, but I think that if you're fearful about taxes, you need to know, first of all, where are you right now? And what are you paying right now versus what you could be or what you think you might be paying?
So a couple efficient things I would suggest to consider is, and again, it would be determined whether Charlotte should do this based on the planning, but Roth conversions is a potential way to get more money into tax-free income in retirement. It has to be very carefully thought out and strategized, though, because if you think about it, and you've heard us say on this program before, it works best for smaller pots of money when you're younger, because you are likely in a lower tax bracket. You're not biting off a lot in one single year, and you have that time for it to grow tax-free. In Charlotte's case, if you're already 55, you've got to be very careful about taking lump sums of your pre-tax IRA and trying to convert that into a Roth IRA, because you might actually end up paying more taxes on it if you're not careful. So it needs to be part of an overall plan, but you might be able to take small pieces of it in the remaining years you have left working, or even more likely, it might work in your first years of retirement when your income is likely to go down. We don't know that because, again, we haven't done the planning here for Charlotte, but most retirees live on less income in retirement than they did in their work years, which potentially could take that tax down to a lower bracket. So I think looking at Roth conversions is something you can do to try to be aware of and potentially decrease the amount of taxes that you have to pay, especially throughout your retirement. And then the other thing, John, I would say, and this is things we talk about, especially if she's so near term here, if she has the ability to start stacking up cash, because the taxes have already been paid on that savings account outside of the minimal little bit of interest that she's going to get on a year-over-year basis. But if you can have a pile of cash, you are not only strong in terms of what might happen emergency-wise or unforeseen things or replacing a vehicle, whatever might come up, but you have after-tax money available to you.
Yeah, you do. And I was just thinking about this, Scott. One of the things, as we've been going through the complexities of this a little bit, I think this is important for most people to understand. And let me use a football analogy, which I'm prone to do from time to time. But, Arkansas has suffered with offensive coordinators that didn't do such a hot job, and now everybody's excited about Bobby Petrino. If you stop and think about this, those guys that were offensive coordinators that just kind of ran cookie-cutter plays, that's what you got, was cookie-cutter results. And maybe even less than cookie-cutter results. But when you have someone who is a strategist, someone who is a tactician, then they can come up with all kinds of cool plays and that actually get really good results. And I think that is the difference between just going to any financial advisor that deals with investments, and they generally kind of know about some of the tax things, versus someone who is an income planner. Someone who's an income planner takes a look at all types of possible strategies for you to produce the most efficient tax efficient income that you possibly can in retirement. And I think that is really the GenWealth difference when it comes to this type of situation.
We're going to name Charlotte's question the question of the week. Thanks for reaching out. We'd love to send you a free Get Ready for the Future Show tumbler, and just claim it by sending us an email, show@getreadyforthefuture.com. And if you'd like to win a tumbler, or if you'd like to get your question answered on the air, get those questions to us. You can call and leave a voicemail, or you can text us a question. Very easy to do. You can do it right now if you're listening. What's on your mind? 501-381-5228. You can hear your question answered on next week's show. Next, it's James from Cabot. My wife is considering leaving her job to be a stay-at-home mom. What are the benefits of a spousal IRA? Is this something we should consider to increase retirement savings? James, thanks very much. First, some clarification here. Not really a spousal IRA. If your wife opens an IRA or a Roth IRA, it's hers. It's not necessarily a spousal IRA. That's not really the terminology. So it's no different than one you might have for yourself. And she does, if she does become a stay-at-home mom, qualify to make contributions to an IRA or a Roth IRA based on your earnings rather than hers if you file a joint tax return. So if that is a great opportunity to consider this, and we don't know how old you are, James, but you can get $7,500 a year into an IRA, whether it's traditional or Roth, until the year you turn 50. And then there is a catch-up contribution. I said 75. It's 7,000. The catch-up contribution moves it to 8,000. So you would potentially be able to get $14,000 to $16,000 a year into two IRAs, even if your spouse is not working. So it's a great opportunity to get some retirement savings into a retirement account, even though someone is not working.
Yeah, and I think another consideration here is the whole thing about Social Security, Scott, because if you are a stay-at-home mom, you're no longer getting the years of credit on Social Security. Now, according to Social Security, you have to work 40 quarters, which is basically 10 years, to qualify for Social Security. And if you've done that, then great. Then you will get a Social Security check. How much that Social Security check is dependent upon what your income is. And if you have years that are zero income, then you don't get any credit for that, and that actually lessens the amount that you could take from Social Security. Now, on top of this is the spousal benefit, and as long as you guys stay married throughout your working years and what have you, she does have the benefit of getting 50% of the spouse's benefit, the worker's benefit, at full retirement age. So those are things that come into play when you make this decision about whether or not you want to have your wife come and stay at home. I will tell you, Scott, many years ago, my wife and I decided for her to be at home. We just decided it was just more productive for her to be at home. And so she did this. Her Social Security benefit is minuscule compared to what mine will be, and she will be taking that spousal benefit. I'm not sure that negatively affected us because at her income level, she probably wouldn't have had a benefit that was bigger than what my spousal benefit would be for her when we turn age 67.
So let's talk briefly about Roth versus traditional. I mentioned it in there a moment ago, but James, if you're considering doing this for you and your wife or just your wife, I do think it's important to determine the difference because you did just say spousal IRA. A traditional IRA, in your case, would actually be funded with after-tax dollars. So I think it makes a lot of sense to consider a Roth IRA here because, again, if you think about your wife's not working, that money's going to have to come in through your income channel, and then you're going to put it into an IRA. Roth IRA dollars grow, as we mentioned in the last question, tax-free. So when you make those tax-free withdrawals in retirement, it can make a huge difference to your overall income because of the tax component to what we just talked about in the previous question too. So I would definitely consider doing this, contributing. It gives your household some tax advantages and additional retirement income. But overall, I would say that you want to build a plan here too to recognize the impact on retirement in making this decision. What can you adjust? You know, some find a way to be a stay-at-home mom or stay-at-home parent and also generate some part-time income. You know, that's a real opportunity here in today's world. They call it the gig economy. There's always some things you can do online, so some additional income there I would certainly consider as well.
Yeah, absolutely. And take advantage of those opportunities because they can make a big difference. And that difference in income might allow for a higher contribution to your spouse's 401k plan. So those are things that you could take a look at and always keep in mind that your goal is financial independence in the future. There's lots of routes to financial independence. You just have to be able to chart your route and be sure you stick to that chart.
I want to remind everybody really quickly of a workshop we have coming up very soon called Protecting Your Family Through Estate Planning. It's on September 17th at 6:30 at the Chenal event venue. You can visit getreadyforthefuture.com/academy to find out how to register for that event and see a list of all of our upcoming events. You know, we've got several coming up over the next few months. This one just happens to be in Little Rock. So find out about estate planning and the benefits of doing that, especially as you get close to retirement. Our last question of the day is from Stuart in Little Rock. I'm worried about a recession. I'm 47 and most of my money is still in equities. Am I too risky right now? Stuart, I know a lot of people are worried about a recession. The question I would have for you is, when are you going to need those dollars you have invested in equities? If you're 47, I'm going to guess it's at least a decade plus, probably more like 15 years before you are going to need to sell any of that. Now, we believe in a diversified overall investment strategy. There's no question that it's likely you don't need 100% in equities, but don't let the fears of a looming recession guide you to remove money from the equity market. We say it all the time, John. Equities are long-term investments. And if Stuart is 47, he likely still has a long term before he needs any of these dollars.
You know, Scott, we're going to keep talking about this looming recession till we scare one up. I'm just telling you, I've never seen anything like it. The stock market is doing fine. As a matter of fact, the Fed has already clearly signaled that they're going to cut interest rates, which generally has a positive effect on equities. I don't know, but other than we've been out of a recession for a long time, why everybody feels like we're going to go into a recession, because there are not that many indicators that seem to think that the economy is dragging that badly. And so, and let me also point out that the economy and the stock market are two completely different critters. They can perform actually completely the opposite of one another sometimes based on who knows what. But let me say this. I think that equities are long-term investments, just like Scott said. You're talking about 10 to 15 years down the road, and you're probably not going to need all that money when you retire the day one. So you really have a much longer time horizon. Time heals almost every wound that you could ever possibly get in the equities market. And so if you have time, then that makes sense. Now, what I would say to Stuart is that you probably should be diversified and be sure that you are beginning to spread some of that risk so that you're not 100% invested in, I don't know, NVIDIA or something like that. And you know, the market goes down in that particular stock, and, you know, all of a sudden your 401k is, as they used to say, a 201k or whatever. You don't want to do that, but you certainly don't want to get out of equities, because what that puts you in the mode of is actually timing the market. And nobody times the market very well at all. I think you have to have a long-term strategy. I think you have to have a long-term plan, and that plan does definitely dictate that you have equities. The reason is inflation.
Yep.
You've got to have that inflation hedge, and that's what equities provide us.
Yeah, I think the way I would say it is, Stuart, you want to remain in equities as an asset class for the long term. But what type of equities might matter, and that could be determined by your risk tolerance. But certainly, as John mentioned, you don't want it all in one or two or three individual equities. ETFs, mutual funds, diversified equity exposure is certainly a better route to go there. And then even for more risk-averse clients, there are products out there that are actually annuities that are tied to indexes that provide you the upside of the market, and in some cases, an accelerated participation in that upside, while at the same time offering a downside buffer against market losses. We've seen these come out just in the last 5 or so years, John, and boy, these are really popular products too. And again, we'd say that don't just enter an annuity just because it's an annuity. Annuities are complex products. They come with many times fees and other things. You want to work with a financial advisor to make sure this is something that's right for you. But having said that, these are opportunities to provide downside protection if that recession comes, because the insurance company that offers the annuities many times, John, will offer a 10, 15, 20% downside buffer.
Yeah, and I think you've also got to think about the fact that retirement is not a stop sign. It's not, okay, at 60 or 65, I've got to stop and I've got to be sure that all my money is 100% perfectly safe. That's not the case at all. It is a yield sign. It is basically a change in course. You're moving from the accumulation strategy to the decumulation or the income phase of your life, and that does dictate a change in strategy, not necessarily a change in asset class.
Well, you know what that sound is. John knows what that sound is because he so adeptly wrapped up his comment as that bell sounded. We are running out of time. Just a couple of minutes left on the show. And, John, time for final thoughts.
Final thoughts from me on this show, Scott, is that there's a ton of misinformation, a ton of uncertainty about retirement and investing. And the only way to deal with that is to just go ahead and sit down and create your plan. You know, we had questions about the economy and the markets and what have you. It is not about the economy. It is about your economy. And it is about whether or not you are able to sustain a regular, predictable, dependable income stream throughout you and your spouse's life. That is called financial independence. And that's what we're about here at GenWealth, is helping you to find, protect, and share true financial independence. That should be your only objective when you think about this, not what's happening today or tomorrow in the markets. Let the markets do what they're going to do. You control your economy.
You know, two of the people that wrote questions in for us today said they were worried. One about a recession, worried about if they had enough money to retire.
Yep.
What is the antidote to fear, John? You've taught us that since day one.
It's education.
It's education.
It's understanding what's going on.
Yeah. So I would invite you to get educated. Hopefully you're listening to this program and that helps. But we have lots of opportunities with our GenWealth Academy workshops to do that. Our next one is protecting your family through estate planning on September 17th at 6:30 at the Chenal event venue. You can visit getreadyforthefuture.com/academy to sign up for that and find a list of all of our upcoming workshops. And that's all the time we have for this week's Get Ready for the Future show. Again, if you've got a question, please send it to us. You can call it in and leave a voicemail. You can text it. That's the easiest way. I think that's the way that most people do it these days. 501-381-5228, and we'll answer your questions again next week.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.